Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today, joining me will be, of course, my colleague Jason Burack and our returning guest, David McAlvany of the McAlvany Financial. David, welcome to our show.
Gentlemen, good to be with you again.
Now, David, we just had an anniversary mark pass. It was the 5-year anniversary of the financial crisis the last couple of weeks. You had the Lehman bankruptcy. You had the FHA start giving out ridiculous loans. Fannie and Freddie were just making ridiculous amounts of collateralized mortgage obligations. AIG, the banks, the real estate market was a bubble that Greenspan passed on to Bernanke. Has anything really been learned in the 5 years since? Have any key changes been made to prevent anything like this from ever happening again?
Jason, that's definitely worth reflecting on. What we see is that banks are bigger and that the notion of too big to fail has not gone away. In fact, the banks that we were concerned about being too big have simply grown in size and exposure. I guess the one positive thing to say about the banks is that they have lowered their leverage, balance sheet leverage, fairly considerably. So from that vantage point, I think they're in a better stead. But they have yet to really make any progress with their derivative exposure. And to some degree, they still get a free pass. They have many of the assets on their balance sheet which they can mark to or price in whatever terms they want. They don't have to mark them to market. In other words, they don't have to be reflected on a day-by-day basis in realistic terms. They can come up with a number that they think makes the most sense for their balance sheet. So I think for the man on the street, that you have to kind of scratch your head and say, well, I don't get to do that. I mean, I look at my stock portfolio and it's either up or down on a given day. How do the banks get more leeway than I do? And that's the Accounting Standards Board has given them some flexibility there. So the derivatives are large and still an issue. The too big to fail, they've become even more system critical. And, the problem, if we should have more speed bumps ahead, is that, while we bailed them out last time, I say the taxpayer via the federal government's balance sheet, the Fed balance sheet is not in the same shape it was 5 years ago. So we're not in a position to have sort of a take two when it comes to a second round of bailouts, should that ever be necessary.
Yeah, and the publicly traded companies, David, if they don't conservatively estimate the assets on their balance sheet, normally they're risking humongous fines from the SEC and all those guys, and some of them, if they're drastically overstating their assets, they're risking going to prison for felony, right? And yet the banking sector seems to get this free pass where they get treated entirely different than the other sectors, as if we have to have these large banks do all this trickle-down economics to the real economy, or the whole economy is going to collapse.
I think you could say that there's been a major consolidation which has occurred, and coming out of the crisis of 2008 and 9, the real winners were the banks. And that's kind of ironic given the fact that they were the ones that sort of brought us to the brink of disaster. It seems that there should be, and maybe this is just my sense of moral justice, there should be some sort of consequence for the actions taken. And yet time and time again, what we're seeing is that consequences are borne by the general public and the taxpayer, while the risk and the private benefit still accrue to your hedge funds, your private equity funds, and your financial intermediaries. So not much has changed. Not much has changed except that they came out the winners, taxpayers came out the losers, and I don't know how you feel about that, but as a taxpayer, it doesn't feel so hot.
Yeah, I mean, the large CEOs, what should have happened was maybe sort of what we did in the 80s with the savings and loan crisis, where all the CEOs were heavily prosecuted. They were thrown in jail for a long time, Charles Keating and all those guys. And then the bad assets were put into a separate bank, and then eventually the assets were sold back to the market. Maybe that would have been a better course of action, but that doesn't seem to have been what is wanted, because the Fed just keeps buying more and more of these mortgage-backed securities. I believe the Fed, owns over 32% of all of them.
Well, I was just going to say the worst thing about this is you hear people screaming for more regulation. And in reality, we already have the laws on the books to prosecute some of these banksters for some of the crimes or fraudulent activities they've engaged in. So I would say one of the saddest things about this is the cry for more regulation when we already have the laws on the books.
I would just add one thing to that, John, that we did let a few of those rules pass into history as Glass-Steagall became irrelevant circa 1999, and the divide between commercial and investment banking was taken away. We learned some valuable lessons in the 30s, and it was lessons about human nature. It was lessons about greed and what people do to take advantage of the general public for their own personal benefit. We saw that happen in the late 20s, and the legislation which was put in place in the early 30s was in large part to address what is a human nature issue. And somehow 1999 rolls around, and both Republicans and Democrats thought perhaps that human nature had changed, but a lot of the games that were played in the early 2000s were played and were legal because Glass-Steagall went away. And again, it's as if we forgot a very valuable piece of information, that people left to their own devices will tend to do things that benefit them, even if it harms other people. There is not generally a charitable gene. And this is not to wax theological, but again, we see human history and certainly our own financial history reflective of the need of some regulation. And the most valuable legislation that we walked away from in the 1930s, or walked away with in the 1930s, we turned our backs on in 1999. And it's no surprise at all that we have the shenanigans still being played on Wall Street. So, you look at the Dodd-Frank bill, and it's a joke. It does nothing to protect the general public, and it does very little to change the derivatives landscape. But what we still have is sort of the basic needs of something I think could be readjusted and put right just by resurrecting Glass-Steagall.
Yeah, and I actually wanted to get into that's some good points. I definitely agree. And I just wanted to get in, switch subjects to the Federal Reserve. September, everyone is expecting a tapering. Jason and I, we now work at the same company where a lot of Keynesians were actually betting on how much they were going to taper. And literally, the Fed said no taper. 2 days later, James Burack, I forget exactly which one, said they may taper next month. Today, Charles Evans. Bullard, yeah. And today, Charles Evans said they may delay tapering until 2014. In my opinion, they can't taper without crashing the mortgage market, the housing market, and, the bond market. Do you think the Fed's going to even remotely try to taper? And do you think they're losing credibility, David?
Well, John, I think those are great observations, and you're coming at it from a similar perspective that we would, looking at cause and effect and knowing that the system is dependent on the lifeline from the Fed. Now, there's two lifelines, actually, low rates and the regular purchase of $40 and $45 billion worth of paper assets. That's something that, although they realize it's not particularly effective towards lowering the unemployment number, that number really hasn't budged much if you factor in labor participation rates. What they are realizing is that if they walk away, they could cause a major financial catastrophe. So no, it's not working towards the originally intended purpose, but they realize that there's a consequence and a price to pay if they simply walk away from the commitment of $85 billion. So yeah, it does boil back to cause and effect. There are ramifications in the real estate market. We've seen a fledgling recovery there. I'm a bit of a skeptic when it comes to that. Seeing a lot of private equity and institutional money come into the single-family home market, not you and me and our colleagues buying a first, second, third home, as you sort of move up the corporate ladder, so to say. We don't see that. We don't see first-time home purchases. The vast majority of these purchases have been institutional and in large blocks, 100 homes at a time, 500 homes at a time, and certainly that's taken the pressure off. of the sort of overhang of inventory. But that still is different than sort of a real grassroots recovery. So I think anything that is there, and I'm going to remain the skeptic, but anything that is there in terms of a recovery can be snuffed out very quickly with a 100 basis point increase. And we saw that in the last 6 months. Even the discussion of taper moved rates better than 100 points, 100 basis points. And, what did we see in the bonds market? Volatility like we haven't seen in a very long time. The kind of volatility that we saw in the bonds market, if you were to apply that to, let's say, gold, for instance, you would have seen gold go from, let's call it $1,100, $1,200 to well over $2,500 in a 3-month period. Would that get your attention as a gold investor in terms of price volatility? Now, that's positive price volatility. In the bond market, we're talking about negative price volatility, but it was radical in nature. And frankly, I don't see many people on CNBC or Bloomberg talking about that, even though it was very painful for bond fund managers. So I'd agree with you, John. I think that we do have a credibility issue with the Fed. They played up the forward guidance issue and trying to tell the general public, here's what we're going to do, here's what we're going to do, here's what we're going to do, to kind of condition the psychology. But what they deliver in the end, a surprise, a disappointment, and certainly people now have to say, so do we trust them? Is what they're saying actually going to take place? No one knows.
Yeah, David, I think what might have happened is that the foreigners heard all this Fed talk, starting in April or March about the tapering, and they said, if you guys are going to do it, we're just going to start dumping our treasuries anyway, because you saw some of that in the data, how there was over $70 billion in net selling from foreign creditors in June, and that basically priced in the taper for the Fed, so the Fed couldn't do another taper because the rates had already moved and been dumped. But in terms of the actual tapering and stuff like that, wouldn't the Fed have looked intellectually bankrupt? Because these guys are academics. They've been extolling the virtues of the wealth effect for, I believe, since Greenspan and how important it was. And if they let, the value of all these assets drop, they would have looked completely hypocritical because they spent all this time, money, and effort writing about how important the wealth effect is for the economy.
Yes, and it's funny how disconnected that academic vantage point puts them at. It takes them to a very strange place because the wealth effect that they've gotten is still, disproportionately focused on the 1 and 2 and 3% of top income earners and asset holders in the country. The average net worth in this country, factoring in real estate holdings, retirement assets, savings accounts, is less than $66,000 for your average adult. So you don't have very much in terms of assets to appreciate. I grant you, if you have $50,000 and it appreciates by $10,000, you're very happy for it. But it's not a particular game changer in terms of being able to retire, 50 versus 60,000. Your wealth effect has been amongst the Carl Icahns. Your wealth effect has been amongst, the Carlos Slims. The wealth effect has been amongst the folks who've just seen, 1 billion turn to 3 or 12 to 20, over the last 2 years as central bank money printing has really juiced the system, both in equities and in select real estate venues. So, yes, the wealth effect is something that's on their radar, but they don't realize that what they're doing, it doesn't have an impact on the economy because although it is buoying certain assets, there's only a few people that own those assets.
Yeah, and that's a good point, David. And when you look at everything here, most Americans, their largest asset is their house. So I think that's why the Fed has been adamant about trying to repair the real estate market, because the average middle-class person, like you said, they don't have that couple $100,000 stock portfolio, but they do have a house that if it goes up 20, 30% in value, they might start spending again or running up those home equity credit lines. And the Fed is just hoping, to go back to those days, I guess, when the housing market was driving the economy.
Well, one other thing is, I was going to say, I listened to your podcast, and you brought up also a point that the Fed could have just been talking about tapering to get people to start borrowing again.
Yeah, and that's, certainly an issue when you look at real estate, you look at home prices in a lot of places around the country having declined by 25, 30% on average, at extremes close to 50%. Those kinds of discounts are pretty compelling when you set them aside borrowing costs, which are historically low. So in terms of affordability, here in the last 2 to 3 years, we've seen the best affordability in housing and in single-family homes that we've seen in probably 50 years because of that confluence of very reasonable rates and a correction in the sticker price. Now, with rates moving up again and there being a little bit of a move of the needle in the sticker price in a positive direction, housing is not as affordable as it used to be. And you're seeing that flow through in terms of your mortgage applications. Not as many from 1 month to the next. So, I think what you can do is begin to discuss taper, and anyone who's on the fence who says, well, I don't know, 4.25%, it's not like 3.25% even a few months ago in terms of my 30-year mortgage rate, but it's better than 5 or 6, and so I better get it done now. Otherwise, although it's not ideal, I just can't wait any longer. So I do think there was a bit of that in the logic.
Yeah, I definitely love. You're the only one talking about it. And speaking about what you've talked about in the past, last time I had you on, gold. It was before the gold crash, and you said gold could definitely go lower. And as promised, it is lower now. So I was wondering, what do you see the gold market right now?
Yeah, I like the gold market. I like the gold market because I think when you look at the flip side, you're really saying I need some form of insurance against the chicanery and the bad judgment of those both in Wall Street and particularly in Washington. And call it insurance against stupidity. That's not going out of style anytime soon because we've got 530-odd men and women back on the East Coast who really need to go back to school and figure out how the world works because they're in a different reality from the rest of us. And, again, so I think we still need stupidity insurance, and I think gold and silver represent that. In terms of the price movement, we've seen a massive consolidation, the kinds of moves that you see once in a generation. We've seen that on the upside, moving from $250, $300 an ounce up to $1,900. That's a great 6.5, 7-fold move, and not something that you can ignore. I think anyone on Wall Street who has ignored it is now trying to ignore it because it's embarrassing to have missed what was the greatest bull market in the last decade or so, well, at least the last decade. Having said that, where do we go from here? I don't think we're done. I don't think we're done because we have yet to fix some of the problems fiscally in the United States and certainly in places like Europe as well. So we will continue to see investors struggle with real rates of return in their equity portfolios. And I think savvy investors who look at a real bottom line, factoring in inflation and taxes, will continue to say, I think it's still good to have a certain percentage in gold. I favor the metals. I like gold. I like silver. And I think both will do well over the next 24 to 36 months. What do they do tomorrow? Well, they could be either up or down. That's a tough one to call. I do think we've gone through the worst. If we retested the lows, even that could be healthy as we move towards ultimately 2,500, 3,000 or higher on the gold price. And, I think we could ultimately see over the next 5, 7, 10 years, silver trading at north of 100, maybe even $150 an ounce. So what I'm surprised by is the lack of patience with most investors. What we've seen so far has been very impressive. Silver coming from $4 and, oh my, it's sitting at $21, $22 today. Is that a problem? Is that a trend that is somehow deficient? Granted, it's been as high as $48 and change. But I think the trend is still in place, and we think that the metals will be very favorable and more favorably treated by the market in months and years ahead, in part because you're going to see confidence in the guys back and the gals back in Washington wane even further. We have that passed here in the next couple of weeks. There's back to that discussion of the debt service, back to that discussion of whether or not we can finance government at this particular juncture in our history. Can we? Well, so far we're living beyond our means by $1 trillion a year. Maybe it's more like 900 billion this year, but it's the reality is the reality. Our foreign creditors, Jason, as you mentioned, they're figuring it out. They are moving to the exit, and we've seen dollar reserves, dollars as a percentage of global currency reserves shrink from 70% down to 63% over the last decade. That's not a rout, but where people are just flocking to the exit. But I think it's the smart money who's gotten out first, and there's going to be a lot of dumb money the world over who figures out they don't want to hold dollars, and that's when you see a little bit more of a flood than the trickle that we've seen. So what does the next decade hold? I think it does entail higher gold and silver prices and lower U.S. dollar values as people begin to question, do we want that as our primary or sole reserve currency? And that has major ramifications for U.S. financial assets. You look at the Dow, you look at the NASDAQ, and you can see in other global spaces where first went the currency, then went the equity markets in those particular geographies. And that's just been in the emerging markets in the last year or so. So, I think we can expect more of the same. Maybe that's not a 2013 event, but I think for patient investors, there's some interesting and compelling step sequences here in terms of growing wealth and preserving wealth. And I think anyone who's got their head screwed on straight should be focusing on wealth preservation right now.
Yeah. In terms of that route, the route has not occurred yet, in my opinion, because there's just so much money sloshing around globally when everyone's on a dollar peg and printing, to maintain an exchange rate, that there's not the place to put all of this excess money into reserves and stuff. The euro couldn't really handle it. The Chinese RMB is not opened up yet for the most part. It can't handle it. They don't have a bond market. They don't have, fully functioning capital markets to the amount of liquidity that the U.S. does. So the dollar is going to continue to slug along. Now, it's going to get cut a little bit here or there every few years, but there can't be the route yet because there's nowhere else for all the money to go.
Well, and Jason, this is the dollar as the world's reserve currency is really one of the greatest con games of all time. And when we talk about smart money already hitting the exits, this is like someone who realizes they've been conned and they know the game's not up yet, and they should maybe ask for their money now before everyone else does, because part of the dollar Ponzi scheme is that you've got to maintain confidence the world over. And if they did not redeem those treasuries or dollar holdings, then the game would be up for everyone. So the first out, you're the best off. The second, third, fourth out, you may not get any back. And that's the nature of a con game. I think we've since 1944 had a privilege which has faded to some degree here in the last 10 to 15 years. But the irony is the world still seems to be content with a promise with nothing really there in terms of collateral. We used to have gold backing the dollar. And so when people put their faith in the dollar, it wasn't putting your faith in the Fed. It wasn't putting your faith in Washington. It was putting your faith in something that was timeless, and that was the gold, the commodity backing paper. We don't have that today. We have this vast amount of faith or confidence in something that has no backing. And that's something that today is fine, but be aware of how frail confidence is. And when it breaks, we will all be surprised at the quickness, the speed, the severity of the decline, not only in the dollar, but dollar-priced assets. So, listen, we could see the Dow motor higher to 17.5 to 20,000 or what have you as this confidence game continues. But the reversal in fortune from, say, 17.5 or 20,000 on the Dow to 10,000 or less will be severe, and the vast majority of people will be sucked in, unable to do anything because liquidity will have vanished. And I think there's a lot of smart people who are basically saying sidelines for now.
Yeah, David, sorry to interrupt you. I think we're in the early stages of a crack-up boom. I just see, you mentioned the real estate market earlier. I see a lot of money from China and Europe just coming in here to the U.S. and paying all cash, and there's bidding wars for properties that there was no bid for literally 3 or 4 years ago, but the foreigners are so worried about their own economies that they're desperate just to come into the U.S. because the perception is that the U.S. still has all these amazing assets, that the U.S. has better rule of law and this and this and this compared to, on a relative basis, I guess, other economies.
And there's a point to be made there. I mean, while some of us may be critical of deterioration in the rule of law, deterioration in, and I hope it's not just sort of some sort of nostalgia for something that never was in this country, but I think there is a slow deterioration politically and socially in this country. Having said that, we still stand head and shoulders above the rest when you're trying to figure out rule of law, property rights, having clear title on an asset. This is still one of the best places in the world to be. So it's not without reason that they're moving here and away from other places. But it's still, I think, an issue or at issue. We have yet to deal with the structural and the substructural issues which led to 2008. Jason, as we move to close, we started our conversation with the 5-year anniversary of the financial crisis. And, what has changed? Very little has changed. We've got William White, formerly the chief economist at the Bank of International Settlements in Basel, Switzerland, here in the last few weeks saying, what I see today is far worse than 2007. The banking system, the financial system has more implicit risk now than that. Is anyone paying attention to this? Bad things happen when you ignore risk, and yet today it's as if risk is being completely ignored. So are we in an environment where bad things can happen? Sure, and that's not sort of trying to ignore the sunshine out today and looking for the singular black cloud in the sky. It's just that we have set the stage, just as we did in 2005 and 6 and 7, for what we had in 2008 and 9. I'm not timing that this year or next year, but certainly it could be in that time frame. If it's not, the longer we wait, the worse it will be. I'd hate to see, what you described as a crack-up boom, Jason, occurring in sort of a 2016 to 2018 time frame, because if we allow the excesses in the system to continue to multiply between now and then, the comeuppance will be nothing shy of what we had in Weimar Germany. The chaos and the social disintegration will be nothing less than what we saw in the torn fabric of society in Germany in the 1919 to 1924 period. I hope that doesn't happen. But what that does mean is that I hope that it happens sooner than later so that it's not as severe.
So, yeah, and one thing I was just wanted to add about the crack-up boom is the weird thing about this market is you're seeing assets that normally don't correlate rising in correlation. For example, the stock market and the bond market. That's changed the past couple of months, but over I would say since the beginning of QE3 and QE4, you started to see that. So,
indeed.
Okay, well, David, I'm sure you're a very busy man. Please, definitely tell our listeners, because we love your podcast. We both listen to them all the time for years now. Please tell our listeners more about your podcast and all the other products and services you have for them.
Well, thanks, Jason. I'm glad you guys have been listening to it. We've been doing that for over 6 years. Every Wednesday, you can go to McAlvany.com. That's McAlvany.com. And listen to that. And, it's definitely like your podcast and an effort that we love. It's something that keeps us fresh and in tune and on top of the details that are happening. We tend to focus not just in the world of finance and economics, but we also look at politics and geopolitics as well, as policies can hit you broadside unexpectedly in the world of investing. So it's not just a question of balance sheet analysis and choosing a good management team when it comes to asset allocating and choosing the proper investments. You have to be aware of the broader picture, and we try to do that with our weekly commentary. For any of the listeners who would like a copy of a DVD that we released, The Fuse is Lit is the title of it, and you can also request that at McAlvany.com. The Fuse is Lit highlights what we see as sort of the unwinding of the U.S. fiscal picture. We think the economy is on the brink of disaster, and The Fuse is Lit, to us, really catches that picture. We don't know when, we don't know how long the fuse is, but it has been lit for the U.S. dollar and for the U.S. Treasury market. So if anyone would like to see our analysis on that, you can have it for free, request it at McAlvany.com, and maybe just in the comment line, let us know that you got it from, you heard it first from Jason and John.
And David, you also manage money too, and you sell precious metals, right?
Well, of course, yeah. I sometimes forget that I should mention the business that we're in. So, we have been in the precious metals business since 1972 and deal with tens of thousands of clients across the country. We've placed billions and billions of dollars into the marketplace. That's something that we do know pretty well. And we also have a money management company. And so, what we see as very challenging times ahead are also times of incredible opportunity for those who, should we say, have the poise of a boy on the burning deck. As we see challenges with the dollar and the U.S. Treasury market, and ultimately the U.S. equity market, there will be, I think, some standout opportunities for those who are engaged. And that's what we really invite our people into, is staying engaged, staying aware, and becoming better and better educated with time, so that as and when value opportunities present themselves, you know how to say yes, versus just stand there scared like the vast majority of investors. So I think, being in the metals business, we're a second-generation family business. Guys and gals that have been with us on staff span, in a lot of instances, 20, 30 years. And so longevity is key for us, as is our client relationships. The vast majority of our clients have been with us 10, 15, 20, even 30 years. So we look forward to recording any questions or any interest that your listeners may have in those regards as well.
Well, I just want to thank you again for your time, David, and thanks for coming on a podcast, and hopefully we can have you back on soon, and keep up the great work on the podcast. We love them, and when our listeners ask us for other content besides our own content, we always refer them over to you.
Well, Jason, thank you for that. And John, appreciate everything that you're doing. I know that through the years since we've been doing these programs, your questions were great, and they continue to get better. Your educational base was great, and it continues to get better. I've got a lot of respect for what you guys are doing.
Thanks. Mutual.
Yep.